Well, hello everyone, and welcome to Momentum Channel. Today we're going to be talking about two high quality, undervalued dividend paying stocks with a dividend yield of over 4%. Let's get into it. The first pick is a company called Whirlpool with ticker symbol WHR. It's a consumer discretionary business with a dividend yield of 4.16%. Whirlpool has a dividend safety score of 70, making it a safe dividend payer. The last price for Whirlpool stock was $168.24. And this business has a market cap of $9.17 billion, making it a mid cap size business. You'd notice the last time Whirlpool increased its dividend, they did so by 25%, just massive dividend increase, which goes back to February of 2022, considered a very fast dividend growth at the time. From a stock volatility perspective, the Whirlpool stock has a beta score of 0.96. Beta is a measure of volatility, and a beta 1 suggests similar levels of volatility to that of the overall stock market. Looking at the key metrics for the dividends of Whirlpool, their payout ratio currently is at 26%, and their forward payout ratio is at 30%, both of which suggesting low levels for dividend amounts in terms of the payout. Suggests that this company has a ton of room for continuing to increase and pay their dividend for years to come. In terms of their dividend growth history, over the past 5 years, Whirlpool has increased its dividend by an average of 7% per year. Similarly, over the past 20 years, they've increased their dividend by an average of 7% per year over that longer time horizon. As for their dividend payment history, Whirlpool has been paying its dividend uninterrupted for the past 31 years. And in the last 11 years of those, they have increased their dividend year after year. Whirlpool currently does pay a total annual amount of dividends equal to $7. Whirlpool does pay its dividend on a quarterly basis, and it's paid in the months of March, June, September, and December. Looking at the timeliness of the Whirlpool stock, their current dividend yield is about 30%, 35%, in fact, above their own 5-year average. And on top of that, their forward price to earnings ratio is only at 7.2. This multiple is quite low, even when you compare it to their own 5-year average of 9.3, which is also half the amount that you see for the consumer discretionary forward price to earning ratio multiple. All of which points out to the fact that Whirlpool stock appears to be undervalued. On top of that, if you look at it, their last trading price is hovering very close to their 52-week low price for the stock, which was at $147.45. The highest that this stock has hit in the past 1 year was $239.47. We're going to take a look at a number of additional financial measures. The first one being earnings per share. Ideally, we would like to see a company that have their adjusted earnings continuously and nicely growing year after year. There are cases whereby it may not be exactly the case. In this case, if you look at the earnings per share growth, you notice there are 3 time horizon in the past 10 years that they have their earnings decline. One going back to 2017, they had 2% decline compared to the year before. Then we had in the last 12 months a decline of 12%, as well as the next 12 months an estimated of a decline of 4% in earnings per share. All of that to say in the next 12 months, the estimated earnings per share for Whirlpool is at $23.20. Despite the fact that it's not showing exactly an upward trend year after year, for the most part, discounting those other years that we talked about, they are on the right track and they're heading in the right direction. We are going to next take a look at their total sales. Ideally, again, we would like to see a company that has their revenue growing year after year. There have been a couple of years that has not been the case, despite the fact that their revenue declined in those years. It was by a single digit. So, for example, the 2020 year was the highest decline that they had, the most amount of decline, whereby their revenue actually declined by 5%. That said, for the last 12 months, this business had a revenue of $21.3 billion, a very healthy revenue for them. If you look at their free cash flow, they are showing a free cash flow kind of margin of close to that 5% ideal range, with the last 12 months showing a 3%, but in 2021 hitting that 5% threshold. On top of that, if you look at their return on equity, ideally we'd like to see this measure to be 10% or more. And in the past several years, in the past 10 years, they've hit that for almost every year with the exception of 2018. In the last 12 months, they're showing 16% return on equity. for the records. Now we're going to take a look at their stock return. Year to date, this stock is down heavy. It's down by almost 28%. While it's a massive decline, remember for the stocks, in many cases investors are rewarded when they are patient and when they identify undervalued stocks and invest in them for the long term. If you look at a 1 year return for this stock, it's down by about 23%. However, if we zoom out and look at the 5 year return, it's fairly stagnant, down by about 0.5%. However, in the past 10 years, if you look at it, you're seeing a cumulative return of 126%. If you look at a longer term for the stock in the past 30 years, this stock is up by 324.5%. Our second pick is a company called First of Long Island Corporation. It's a financial sector's business with ticker symbol FLIC. It currently has a dividend yield of 4% and a market cap of $458 million, suggesting this business is a small cap business. The stock price last traded at a price of $20.02. And if you look at the last time that they increased their dividend, it goes back to September of 2021, whereby they increased it by 5.3%. First of Long Island Corporation is a safe dividend payer with a dividend safety score of 70. And the stock of this business is very low volatility with a beta score of only 0.39. First of Long Island operates as a holding company for the First National Bank of Long Island that provides financial services to small and medium-sized businesses, professionals, consumers, municipalities, and other organizations. This business was founded back in 1927 and is headquartered in Glen Head, New York. In terms of their dividend payout ratio, their current payout ratio is at 41% and their forward payout ratio is at 38%. The forward payout ratio of 38% is considered low for banks. In terms of their dividend growth over the longer term, if you're looking at the average in dividend increase of 7% per year in the past 5 years, and over the past 20 years, this business, the First of Long Island Corporation, has increased its dividend annually by 10%, suggesting a fast dividend growth over that time horizon. In terms of their length of their dividend payments, First of Long Island Corporation has been paying its dividend for the past 28 years, which is quite decent actually. And they have increased their dividend in all of those past 28 years. Their annual amount of dividend payment, if you look at it for the whole year, equates to 80 cents per share. The First of Long Island Corporation does pay its dividend on a quarterly basis, and its dividends is paid in the months of January, March, July, and October. Looking at the timeliness of the stock, their dividend yield, which is currently at 4%, is about 18% higher than their 5-year average, which typically sits at 3.39%. On top of that, their forward price to earnings ratio of 9.6 is less than that of their 5-year own average of 12.4, all of which pointing to the fact that the stock appears to be undervalued at this time. Their current price of $20.02 hovers somewhat in between their 52-week low price of $16.78 and their 52-week high price of $22.75. We're going to take a look at a number of additional financial measures, and the first one being earnings per share. In this case, you notice only in 2013 and 2019, their earnings per share had a decline. Other than that, in all the other years, in the past 10 years, they've increased their earnings per share compared to the previous year. With the next 12 months, they have an estimated earnings per share of $2.08. If you look at their total sales, they have been able to increase it year after year in the past 10 years, with the only exception being 2013, whereby they almost kept it stagnant. In other words, in the past 10 years, you're seeing that nice gradual increase to their total sales, with the last 12 months showing $124 million in total revenue. We're going to also take a look at their return on equity. Ideally, we'd like to see 9% or more for the banks. And in this case, their return on equity is at 11% in the last 12 months. And in all of the past 10 years, they've surpassed that threshold of 9%. We're next going to take a look at their stock return. Year to date, this stock is down by about 8%. If you look at the past 1 year, this stock is down by about 6%. However, over the past 5 years, this stock is down quite extensively, down by about 26%. It does get better though. If you look at the past 10 years, This goes back as far as back as 2012. The stock is showing a cumulative return of 51%. And if you look at the longer term, this goes as far back as 1995, close to that 30 or less than 30-year time. You're looking at a total cumulative return of 607% plus. Quite decent return over the past almost 27 years or so. Well, there you have it, folks. A quick look into two high quality dividend paying stocks that are considered and appearing to be undervalued at this time. Are you invested in any of these stocks? Which dividend stocks are you currently buying and adding to your portfolio? Let us know in the comment section down below. As always, if you enjoyed this video and gained something of value from it, please don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing in dividend stocks, growth stocks, penny stocks. We also talk about investing in crypto and ways to reach financial freedom. Thank you, and I hope to see you next time.